Thank you very much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, what the much better than expected GDP report means for stocks in the new year. We'll discuss and debate that with the investment committee today. Joining me for the hour, Joe Terranova, Stephanie Link, Jenny Harrington, and Josh Brown. Taking to the markets, a bit of a mixed picture today. Headline, though, GDP, much stronger than expected. 4.3, highest read since Q3 of 2023. You know, Josh, I wonder what this does to the thinking on rates. Torsten Slok at Apollo says long-term interest rates will remain higher for longer. Investors should plan accordingly. Deutsche Bank today, ratchet higher for yields is a significant story. I mean, we've been talking about and gaming out and planning for a rate cut in early 26. What if the Fed takes a hawkish tilt? I mean, do investors need to rethink this whole scenario if growth is going to remain stronger than expected, if there's going to be a run it hot idea?
Yeah, look, without a doubt, there are segments of the market that have benefited from the Fed cutting and from this idea that whomever Trump installs next year is going to have a bias toward lower rates, almost no matter what the data is. And as a result, yesterday we were talking about the Dow transports having unbelievable performance. We've talked on the network about small caps almost endlessly over the last month. And these are all areas where that idea of a little bit of easing and a little bit more accommodative Fed policy, it's important. Like, it matters. It matters not just to the fundamentals of the regional banks, which we talked about, but it matters to sentiment around these sectors as well. It matters to the potential for multiple expansion. And so it is notable. The thing that I would point out, though, is higher rates are a phenomenon around the world. In Japan, they raised rates twice this year, which sounds like nothing, but for Japan, it's a really big deal. They did a 50 basis point rate hike to start the year, and just a week and a half or 2 weeks ago, they did another 25 basis points. And if you look at the 10-year on the Japanese bond, it's gone from 1% to 2% this year. Again, doesn't sound like that big of a deal until I remind you, it's Japan. So we are seeing higher rates around the world. And I think what'll be different about this cycle, I'm hoping, absent a financial crisis or another pandemic, there's no reason for investors to believe that we're going to run right back down to 0% interest rates. I know that's people's default setting, given the history of the last 15 years since the great financial crisis. But there is this possibility that intermediate, longer-term rates look something more like 3%, 4% than 0% to 1%. And that's just the world that we're in. I think stocks can become accustomed to that idea. I don't think it's the death knell of the bull market. And frankly, I don't think rates need to go that much lower, just given where economic activity is. So I think we're okay, but I do agree with you, Judge. It's a story.
You know, Steph, rates going up for the right reason, I'm anticipating what I think you were going to say, are still rates going up. And, you know, a Fed with a willingness to run things hot still has the risk of stoking inflation any higher than it is now. I feel like the market today looks at the GDP report and is trying to figure out what it means in the bigger story. Yes, the economy is good by this measure, obviously. Now, there's some trade things in there and what have you. Productivity is having a real impact on growth. So 24% of the S&P in 2023, 23% in 2024. We're clocking 17% gain right now. Who knows what we're going to do over the next and last few days of the year. But how do you put it into context, what this all means for the equity market in the new year?
Well, I'm going to celebrate stronger than expected growth. You know that about me, right?
That's right.
4.3%. We haven't seen that in years. Number one, consumption, 3.5%. The consumer was supposedly dead, Scott. They're not dead at 3.5% personal consumption. Savings at 4.2%. That's better than historic numbers of 2%. You mentioned productivity. You nailed it. Productivity, we haven't seen productivity like this in decades, and that's going to help the inflation story.
And it's only going to continue to increase, obviously.
Of course. So in a 2% GDP world, let's just say we get back there. I don't see it, but you can grow earnings at 8 to 10%. That's really usually what we do, what we see. we're going to see probably mid-teens, low teens to mid-teens earnings growth in next year, given the momentum that we have. And it is the consumer, and it is AI, but it's not all AI, right? Everyone was saying that, oh, the only reason we're growing is because it's the AI boom. Well, it's also a very important piece of our economy is the consumer, so it's very important to watch that. So I think you're going to have better earnings. So you asked me, are we going to grow 17, 20, 24% next year? I don't really know in the market, but I do think if earnings are too low and earnings get revised higher, the markets will be higher. And my base case is something like 10%. The long-term average is 7.7%. We should be happy with that. But long term, I mean, I feel really good heading in because I think estimates have to move higher.
But long-term rates higher for longer, if Slock is correct, and investors should plan accordingly. What does that mean? How should you plan accordingly if you think that rates are going to be higher for longer?
Okay, well, let's put it into context. First of all, the U.S. 10-year Treasury has not been below 3.5% since June of 2023. During that time frame, the S&P is up greater than 60%. So the market can go higher with an elevated U.S. 10-year. I think what's important to think about in the scenario you're describing is where is bond market volatility? Because bond market volatility this year has been very calm. It's been a benign environment. If you're sharing with me that in 2026, it's going to be in an environment where we have a very wide range for a U.S. 10-year Treasury, that's problematic. And I think ultimately the places that takes you to as an investor is the places where you're most comfortable. You'll probably make the return to large caps over small caps. You probably want to own the Mag 7. You want to stay high up in quality in the financial services. You want to own the big money center banks. So I think that's what's important when you think about where yields are going to go in 2026. What's the volatility that correlates with whatever the price direction is?
What happens if the Fed does take a more hawkish tilt? Like even somebody who's really bullish on the markets consistently, like Tom Lee, is not expecting this incredible year next year, that the first half of the year could be a little bumpy, and maybe you could even dip into a bear market before you pick up. Those are his words, not mine. Yeah. He's the one who is as bullish as anybody, but is suggesting that if the Fed is more hawkish, if rates remain elevated, that maybe some of the great feeling about what's happening is going to be hard to materialize, at least initially, especially if you say, well, maybe the first half of the year, the Fed's in the penalty box. They don't have a new chair yet. We don't know who it's going to be till May. Then you have to wait for a meeting. So you're 6 months into the year. And if you have hot GDP like you do now, with inflation a little bit elevated, they're not going to be so quick to want to cut rates necessarily.
I think that's right. And I think this is perfect timing because it's not time right now to look back. And while the economic data just came in great and it was strong and it was hot, I care a heck of a lot less about those numbers than I do about what I think they'll be in the future. And I'm not sure that they're so predictive. They were hot, and I think everybody knows that there might be some noise and some missed data in them. Not a lot, but a little. So we look forward and we say, do we really think that those numbers will continue at this pace and in that direction? Pace? I don't think so. Direction, maybe. You know, has the market at up 17% year to date? Has it already incorporated all that great news in? You know, what's the leadership of next year going to be? And if Tom's right, you know what you do with that? You take a little risk off the table. And this doesn't mean get bearish. This doesn't mean cash out of your stocks, but maybe you take a little risk off. Maybe if you're 100% in kind of a growthy equity portfolio, like why not take 10%, 5%, 15, whatever makes sense for you? Why not put a little in? Because if you're thinking about this now, you're going to feel pretty badly if Tom's right and there is a short-term bear market coming and you didn't do anything. So I think it's a great time to think forward, to reposition a little. I don't know. I think it's hard.
Well, I mean, yeah. Certain things may not work. Like your housing trade. I don't, and like, look, housing stocks are down today. No shock. If you're talking about longer term rates remaining elevated, you can't convince me that this trade is going to work. It's antithetical to what people had thought was going to happen, right? I mean, I'm looking at Steph squarely because this has been one of her leaned on areas of the market.
Yeah,
how do you counter that?
And I still like housing for the long term, but I have recognized you need lower rates. We have gone from 7.4% in the 30-year fixed to 6.3 today. We need to get that in the mid-fives. But in the meantime, the companies, the best-in-class operators, are managing as best they can. You are at trough levels in gross margins and operating margins for something like, let's just take D.R. Horton, which is what I own, but you're at the trough levels. You are at 13 times forward estimates. Numbers have actually been de-risked. Not a lot needs to go right. I will acknowledge, to get better revenues, you need better demand, and that will come again as rates come down. But I do believe there's enormous pent-up demand, where we are 5 million homes short in this country.
Everybody knows that. I hear you,
I
but
know,
why
but
would you wait?
I'm going to tell you, it's not going to take much.
How long are you willing to wait? Because if you've liked it for the long term, you've liked it for the long term the past few years when rates have been elevated and the market's been an ice cube.
And actually, I've made money in the name because I did buy it pretty well. And you have fits and starts. They're kind of like have been in this trading range. Any whiff of lower rates and these things take off. And right now we're waiting, but I do think the Fed is going to continue to ease. I don't know if it's 1, 2, 3 times next year, Scott, but you are getting, to Joe's point, a dovish new Fed chair come the spring, and they will be. And I think they can, because the labor market is cool enough for them, and inflation, if you look at rents and wages, they're coming down, and inflation is coming down. So I think you are going to continue to see the Fed be accommodative, get to neutral policy, and that should be enough to get these really down and out stocks to work.
So, Steph, the one thing I disagree with you on is that I don't think you need to have rates get down to that 5% for it to move.
Yeah, you do.
No, here's the thing. Here's my argument, though.
Sustainable
I think you need to do
demand, yes.
exactly what Torsten Slok says, and I think you need to plan accordingly. I bet you when all of us bought our first house, mortgage rates were about what they are now. If people can adjust in their minds, like maybe they're not going to see 5%, maybe they're just not, and you need to suck it up and you need to go with a 6.2% mortgage now, maybe if they can adjust and plan accordingly, maybe things can move before rates get there. And I think that's this challenge, is because there's been so much chatter of the Fed's going to cut, the Fed's going to cut, then everyone just keeps waiting and waiting. Like, what if we get a hawkish read?
That's
right?
that's all fine and good, trying to tell people who are in a 3-handle mortgage that, hey, just suck it up and go at 6
No, but
It's not going to be coming
if you
from
need a new house.
It's not going to be coming from existing home sales. It's going to come from new home sales. That's one of the reasons why I own the stocks that I do, because they're very dependent on the first-time buyer and a new home.
Does this idea of higher rates do anything to the financials trade, Josh? Along, if you pair that with a more hawkish Fed, like if you have the short end maybe start to move up a little bit, you don't have as steep of a yield curve, which was one of the big thoughts behind, well, net interest margin and all that makes perfect sense. If you have a steepening yield curve, then you're going to have more benefit from that. Maybe not so much. I'm not suggesting this trade doesn't work all of a sudden, but I just wonder if you need to factor this in, plan accordingly, as Torsten Slok would say.
I don't know. I feel like the market is very smart, and you've had unbelievable performance in the financials this year. The banks in particular, the large banks in particular, were just absolute standouts. And frankly, we did not get a ton of rate cuts this year. It wasn't the important thing. The important thing, and maybe it's a dirty little secret, the bank stock investors are not necessarily rooting for cuts and cuts and cuts. These banks make a lot of money with where rates are right now, on the asset management side, on the banking, yes, on the banking side too. Yeah. And I just don't think like a ton of rate cuts are the thing that's driving performance. Citi is the second best bank stock in the market this year, a financial stock after Robinhood. It's up 70%. Goldman up 60. Right, BlackRock up 53. Morgan Stanley up 43. You're telling me that performance is based on 3 rate cuts next year? No, I think there's so much more going on. Financials, as it stands right now, are expected to grow earnings 9.3% over the next 12 months. I think they'll probably outdo that, and I don't think that rate cuts are a necessary ingredient. On the housing side, Stephanie is right. It's really going to be new home building that's going to represent the housing cycle. And I don't think the 30-year is necessarily the thing to watch. I think it's the 10-year. Mortgages key off the 10-year, and refi activity keys off the 10-year more so than the long bond. And from that perspective, you say like, oh, are we going to see short rates go up a lot? I don't know. I think it's more the volatility of rates that might have a bigger impact on the way people think about these stocks rather than the level itself.
I think that's why Joe was, I think alluding to as well, volatility in the bond market and what happens there. I love this note today, this blurb from a note from Goldman Sachs. As they think about the new year ahead, they think about the broadening trade. You can factor in today's GDP report in any way you'd like on how you think that's going to impact stuff. But they say, quote, consensus expectations are calling for notable year-on-year accelerations in EPS growth everywhere outside of TMT. That's the NASDAQ, tech, media, telecom. So they lean heavily on the NASDAQ, obviously. Is this likely to play out? Does Micron's print serve as a reminder of the beat raise potential in tech? In other words, maybe, all these expectations are Jenny, so high outside of tech. But Micron's like, okay, remember, which, by the way, is up 228% year to date. Here's the power you get of an earnings growth and beat and raise and all that from tech relative to everything else. And you can make a broadening story all you want. It's not going to look as great as you're going to get from tech, which is going to continue to deliver.
I think that's right. And so, again, as we look forward and we think about who the leadership is next year, it was so interesting to me looking at the list of returns on chips year to date. NVIDIA's up 37%. That's amazing. It's also the worst return in the list we've got, with Micron leading and Teradyne, which we own, up 56%. So it really is about where those expectations are. How easy is it going to be to beat? There's a couple of stocks in our dividend strategy where they're trading at like 10 times, 9 times earnings. They should have, 12, 13, 14% earnings growth next year. That should be a very easy beat. Nobody's talking about that. Nobody's looking at that. So I think it's about expectations, both in tech and out of tech.
Is this, Steph, a reality check on the broadening idea? That, yes, you can get broadening, of course. I'm not suggesting that you can't, nor are they. But if you think of where you're going to get the most reliable earnings growth, it's going to come from tech still. And it's not going to be as reliable in all these other places, despite the story that people would like to tell.
I think technology, absolutely, you have very strong earnings potential and amazing free cash flow. That is not going to change. And in fact, even if you look at some of the Mag 7s and some of the technology companies that are spending on AI, even though they're spending so much on CapEx, they're still generating a lot of free cash flow, which is one of the reasons why you and I talked about Oracle and why I would not buy that one, because they don't have free cash flow. But a lot of the other ones do, and I think you're getting an opportunity. But that said, I do think you're going to see a great earnings story from financials. And it's not, you're right, it's not just NII. I mean, do you know that global M&A year to date is up 27%, and in the US up 56%? Capital markets activity, loan growth, the consumer, all of that. So financials, I think, are going to they set up very well, especially with deregulation, because they're trading in the mid-teens on a multiple basis. And I know we don't use PE for them, but let's just use this exercise. They're not trading at 23 times, and you have deregulation. So I think I agree with Tom Lee in terms of they can trade. Do they trade like technology stocks? Maybe not, but they can trade higher. So that's number one. Industrials, they absolutely benefit from this AI CapEx cycle. And you've heard me say I own a ton of those names, and those earnings are coming in at 30% because their backlogs are 20 and 30%.
Sure. Do you feel? I guess the point of this note is like, do you feel as confident that you can bank on the kind of earnings growth that is projected right now from everything outside of tech as you do inside? Or are you more susceptible to disappointment from all of those other areas, which then would call into question the broadening trade, which is why people would go back to tech, because it's more tried and true. They can count on it more.
But I don't think it needs to be one or the other. I think you can barbell it.
I know, but it's going to come, ultimately it comes down to what earnings are going to deliver.
But I think what I just laid out, why financials are going higher, why industrials are going higher, while the grid companies are going to go higher, because we haven't upgraded the grid in 50 years, and the backlogs there are huge, why we don't have enough power. How about the aviation cycle? That's on fire between buying Boeing and Airbus, and so there's that. And then you have automation, which we actually haven't even talked about, but I've been buying slowly Rockwell Automation for that very reason. Because guess what, Scott? They went from 3% organic growth in the second quarter to 13% organic growth in the past.
Some of this has to be priced into these stocks at this point, which is why it has to live up to the hype.
Well, and I think
the charts don't lie.
I think the challenge is you can say tech, if we're talking about just the sectors and not the stocks, you can say, yes, as a sector, tech probably is the most predictable. But then even in industrials, like you get to be in the good industrials, right? Because you don't have this dividend need. But in the there's also really crummy industrials with terrible, or even think about financials. Like it's a huge difference between Citi and Blue Owl this year.
So maybe this will be a stock picker's market. But
I wonder about that. But I think it's harder to make the argument. Each sector collectively has more disparity other than tech.
But this is why you have to focus and understand within industrials. You don't want to own machinery, but you do want to own the companies that are helping to build out the grid and that sort of thing. Right. So we have. I think we're saying the same thing. Maybe it's not holistically industrials, but there are a lot of industrials that are going to benefit. And oh, by the way, the PMIs are still below 50. That's when you buy industrials, by the way, because that's when you really see the inflection to earnings, which is what Scott is asking. I have a lot of confidence, given the strong economy, you are going to see a recovery in PMIs next year.
You and B of A. I mean, they're talking about industrial momentum. How the indicator that they look at is flashing a positive note. They mentioned that one specifically, which you do have. I want to get to a move that you have as well in the best performing sector of the quarter, which is healthcare. So you got the news today on the FDA approving the first GLP-1 pill from Novo. You like animal health, you have, and you bought more Zoetis. Tell us why.
Do you know it's been not since March of 2021 where this stock, Zoetis, has traded at a discounted multiple to Elanco. Now, congrats to Elanco. I happen to own it, but it's up 81%. It's a turnaround story. I'm inclined to take more profits there, because it's now trading at 23 times forward when I was buying it at 11. Zoetis, on the other hand, average 30 times. That's its average. It's trading at 19 times, and it has massively underperformed for good reason, because the CEO cannot execute. The last 3 quarters, they actually have come in line, but have lowered, and that's the reason the stock hasn't done well. Now I think it's gone overboard. I still like the total addressable market. I don't know if the CEO is even going to be in the seat a year from now, but she better get her act together, or you're going to have activism, because this is a 3-legged horse, right? Or race, rather. This is Zoetis, this is Elanco, this is IDEX, which Joe owns, and it's a total addressable market that's going to be $100 billion by 2035. And these guys used to be the leader. They still are. They have 20% market share, but they haven't executed. And so I'm assuming that I'm taking it into consideration next year. You have a mean reversion.
Well, Piper says it's overcorrected, and that your willingness to support the new product launches in 26 and 27 will likely be rewarded.
Yeah.
Maybe you have to wait. They have a neutral on it still.
Yeah.
But it sounds like you're willing to obviously do that. Your favorite trade of late's been the XBI?
XBI, favorite trade. The veterinary trade is a very strong trade. Let's also mention IDEX is in the midst of a little bit of a pullback here, sitting right at the 100-day moving average. Perfect spot from the perspective of a low-risk point of reference.
All right, metals have been in the news this week. We might as well hit those before we go. Gold, silver, new record high today. Copper having its best year since 2009. Freeport, Jenny gets the target up today to 55 from 47. Wells says overweight.
Yeah, and even with the positive return and it doing so well, you still have a company that trades at 17 times earnings with a 7% free cash flow yield, and it's one of the only ways to get a pure play on copper from just an easy stock.
You sold Freeport for ANTO.
Yeah, because the execution is so spotty at Freeport. So that's the reason it trades at the multiple that it does. And if Augusta actually is the best operator with the best production growth of 30%, and it trades at 11 times EBITDA. But if copper goes higher, both of these stocks are going to go higher.
All right, we'll take a break. Live Nation, Josh, top pick at Evercore today. What do you think about this stock moving forward?
Look, I think this is a crown jewel type of name. There is no other way to play what is arguably one of the biggest secular trends of our lifetime. We thought people would lose interest in going to concerts sometime after 2021, 2022. If anything, it's intensified. That will not change next year. This is a one-stop shop to capture it.
Steph, you initially bought Estee Lauder on the 16th. You added more just 2 days later.
Yeah.
The target today to $100 at Jefferies.
I really like this story for 2026, Scott. I really think this turnaround is just beginning with this new CEO. The U.S. and China are seeing a recovery in prestige, makeup, and cosmetics, and they have a margin rebuild plan as well. So I think if they can get the execution right, they've got the products, and they're working on the cost-cutting side. So I really like the setup for 2026.
It's notable, though, that they raised the target to only $100. Stock's at 107.5.
Yeah, I mean, I think it goes. I think it
Sounds
goes
like
a lot
it's
higher.
like maybe they're non-believers.
I think it's a show me story, Scott, right? And so I believe I like what the program is. It's called Beauty Reimagined Strategy. That's what they're calling this turnaround. And this CEO has been at the company for such a long time, and he knows the prestige market very, very well. I think China really was a problem for them in terms of their distribution, and they're fixing all of this. And so I think it'll be a slow turn, but I think it's a turn.
Okay, AME is a record high today. Emtech. Joe, that's you?
It did, industrial name in the right place as it relates to electrical equipment and supplies, whether it's commercial aerospace or utilities itself, seeing really strong momentum. Having exposure to commercial aerospace has been important in 2025 and in 2024. One of the names we've owned over the last several years has been Howmet.
Yeah.
Howmet has been really, really strong tailwinds there. But Amtech continues to press higher. It's cheap on a valuations basis. I think Josh has it in best stocks in the market. Correct me if I'm wrong, but I think I heard him mention that as well.
He talked
yeah,
about,
we did it 3 weeks ago.
Yeah,
I mean, obvious
FedEx.
breakout and no sellers in sight.
I'm sorry. You talked about FedEx yesterday. I bring it up because it was reiterated by Deutsche. Quite ironically, they say one of the most inexpensive names in our coverage posted the best numbers to close out the year. Yeah. Again, you highlighted it yesterday, so give us a little reminder as to why.
Yeah, look, this is a stock that I was surprised to see it on the best stocks in the market list because they've had a lot of the same challenges as at UPS, but there's a turnaround happening here, and when they reported last week, I think that was solidified in the minds of investors. I mentioned 300 to 315 as an area that's been resistance multiple times. It's going to make another run at that. I think this time she gets through. One thing to keep in mind is that in June, they're going to be spinning off the troubled freight division into its own publicly traded company. The ticker will be FDFX, and a lot of people are talking FDXF, and a lot of people are talking about that as a moment that will unlock a lot of shareholder value here.
All right, we'll take a break. Final trade while I have you real quick, please.
Oh, boy. Okay, I'll give you Millrose Properties, which leads into Steph's housing play. 9% yield, excellent company.
Josh, final?
ExxonMobil breaking out.
Steph?
I like the India ETF, INDA.
Semis, NVIDIA, Broadcom, all of them going higher.
Okay, so I'll see you at 3. We got Adam Parker, Ed Yardeni, Cameron Dawson, Bryn Talkington. Kevin Simpson's got some new moves, too, and we'll certainly game out 2026. I'll see you in a couple hours on the bell.
It's typically occurs between the last 5 trading days of the year and the first 2 of the new year, meaning it should begin right about now. Okay, Tom Lee is banking on the markets, and they will deliver, and he will join us shortly to make his case.
He is in studio, on set with us. Good man. Speaking of Christmas, one day left to get your gifts, but not even one day, a few hours. But survey after survey is showing consumers are feeling a little blue this shopping season. They're still expected to spend a record amount online and in stores. So where are they buying, and what will happen in the new year? We will discuss all that. Financials have also been on a tear. I don't know if you've noticed the big banks reaching new highs day after day. Is it still a good time to get into some of these names? We'll get you the answer from the bank expert over at UBS.
Okay, we start with the markets as we are less than an hour from the close of this holiday shortened trading day. The S&P 500 hitting a new all-time high fresh off of yesterday's record close. A record close today would be the 39th of the year for the S&P, and our next guest thinks there's more room to go before the year's over. Let's bring in Tom Lee, head of research at Fundstrat and a CNBC contributor. Tom, just tell me something. This Santa rally, is it a thing like a fake virtual thing, or is there a fundamental thing behind it?
I think there's actual real stats behind it. The Stock Traders Almanac, the Hirschfeld guys actually have shown that this is a good period between basically the 1 week before the end of the year and the first few days.
But why is it? In other words, I always thought like people around this time are maybe selling stocks to give money to charity, pay bills, those sort of things. I would think there would be downward pressure on the stock market at the end of the year. And by the way, especially on a good year, trying to lock in gains so it's in the calendar for the records.
Yeah, I mean, I could say that I can see window dressing playing a role into year end. Professional money managers want their winners to look good, so they bid them up into the end of the year. And then the first part of the new year, I think, makes sense because that's when people allocate into asset classes. So there's money going into stocks in the beginning of the year.
That's the first couple parts here. I'm an anti-technical person, Kelly.
You don't like the chart stuff.
I don't like the chart stuff. I'm a fundamental guy, and I want to know if there's fundamental stuff. That was the thing. Tom, let's talk about which areas you think for the new year might be areas that are not well covered and maybe ones that are a little off the radar, the sort of, I don't know, the headwind, or tailwind, tail risk things that are out there right now.
Yes, I think in 2026, there's going to be likely a more dovish Fed. And that dovish Fed will allow business confidence to recover. So the ISM, I think, recovers back above 50. And that's going to be a tailwind for traditional sectors like industrials, energy, and basic materials. So I think those are sort of three groups that should do better in 2026 than 2025. But then there's also, I think, some tailwinds building for the financial services, which you guys mentioned are doing well, which is that financial services companies are really big beneficiaries of AI, and they're big beneficiaries of using blockchain technology. Both will allow them to reduce their employee intensity of their business. And so I think the large tech-forward banks are going to start to see margin expansion and trade more like tech stocks in the future. Wow. And that's why, the JP Morgans and the Goldmans could actually be the next Mag 7.
Can I just put a footnote or a footnote question on that? What about the deregulation part? Mickey Bowman over at the Fed has been very busy trying to make it easier for banks relative to regulations. Is that part of your outlook as well with the banks?
Well, that would be a very big tailwind, too. As you know, banks have been strangulated, especially post-GFC, and so it's removing some restrictions would be helpful, as long as you don't remove safeguard rails.
I've seen the market this year, Kelly, trade a little bit on some of the deregulation news. It wasn't something, as the year went on, it got to be more serious, and the idea that they were going to be reducing.
Because I can never I don't read the breadcrumbs carefully.
Oh, God, it's so miserable.
But it's...
I hate covering bank regulation.
It's not like you wake up and someone goes, oh, this earnings report came out, or you wake up and so I'll read an analyst note that says, yesterday in a hearing, this person indicated this, and so it's hard for me sometimes to draw a straight line.
You're so clever about that, because that's kind of the way it happens. It drops in a hearing, it's discussed by a Fed official in a speech, and then it's proposed, and then there's a 60-day comment period, and then they adopt it.
Right. And then
so between and there, it could be like 9 months or a year, and I'm not sure when, but I've seen some of the actual adoption things move some of the stocks in a way that seems to be what Tom is talking about, this idea of thinking about banks having to hold somewhat less capital as the year goes by, especially, by the way, interestingly, I don't know, you went to the regional banks, that they're an area that may benefit more than the larger banks.
Yeah, regional banks, I think, are part of the reason we like small caps, because as interest rates decline and as business activity picks up and potentially M&A pick up, this really plays into the favor of regional banks.
Tom, it seems like you're describing a year next year that could have strong growth but also low interest rates. Are those two things at odds with each other and in tension?
I'd say, I know when people talk about low rates, it depends if they're looking at, long rates, short rates, or even, usable rates. But I do think next year is a year where parts of the economy that have been suffering from high monetary policy rates may actually do better.
Kelly, can I have a macro minute here?
Please.
All right, so follow me on this, guys. I'm interested in your thoughts. Guys, if you have in the back there, let's do the real spending chart, okay? We just made that. That's CBHM, in case you're interested. And it shows pretty good spending, right? If you adjust for inflation, it's not too shabby. I don't know if we have it. I'm sorry that I'm pulling this on them in the back. Anyway, it shows it's like this. There we go. There's the real spending. Good numbers, right?
Yeah.
Let's go to the real income chart next. And I'm still within my macro minute here. Oh, they're so good in the back there. Ugh.
Wow.
Doesn't look so good.
Face plant.
And now let's look at the difference between the two, which is the savings rate. And that's how we do math on national television. And there's the savings rate coming down. Suggests, Tom, some pressure there for the consumer. You can't keep going with incomes being flat, adjusted for inflation, and spending being higher because something's got to give. What's your take on those three charts right there?
Well, I mean, I think you're hitting a key point, which is inflation hopefully is tamer next year. And I think that that's going to be
And at a constant wage growth, that means incomes would be higher.
Yes.
Real basis, right?
That's right. And in terms of spending, I didn't realize that there was such a gap the last 2 quarters. Is that
well, it's the last quarter especially, yeah.
Yeah. But, you know, in some ways I can see consumers, you know, next year there's the wealth effect from stocks.
And the tax refunds as well.
Yeah, so
could help.
Yeah, so I don't spend that much time thinking about savings rates for consumers, but I think leverage is still not too high for consumers, so I think there's still room for the consumer to be healthy.
Yeah, so you see a good year for the market.
Yeah.
Even though I think we've rarely had more than 3 years of double-digit gains. Sam Stovall was saying last hour, but you know we have had a 5-year run of them, and it was in the 90s when we were having something called the internet, and here we are in the AI boom. So I don't know how lofty my expectations should be about what this market can achieve now, or if the fact that I'm even asking if we could have a run that strong means sentiment is too one-sided and we're all due for some kind of correction.
Yeah, I mean, I think as 2025 comes to a close and the market's up 18, I think we have to remember that this was a very difficult year because from February to April we had a bear market. And we've had 7 corrections of more than 3% this year. So as much as this is like an up 18% year, it was a year of a bear market and then a recovery. So I think next year probably feels that way too, that it could have a replay where there's a very big decline and a recovery. But since 1928, there have been 12 large markets where 3 years of 20% gains have been realized. And in the 4th year, half the time, the market does better. So there's a equal odds that we could actually do better than 20%.
Tom, we're out of time, but real quick, your biggest risk to this whole lovely forecast?
Well, I think that complacency still is the biggest risk. You know, that we are underestimating risk, and that's watching the VIX. But, you know, my clients are pretty cautious, so I think the good news is people aren't that complacent.
They're worried enough.
Yeah.
Tom, we'll see you a little bit later this hour for more. We really appreciate it. Today, Tom Lee, he'll give us his top stock picks, individual stocks, a little bit later on. And we also just had the last Treasury coupon auction of the year. There was some pretty good demand for those 7-year notes, around $3.90 right now. Rick Santelli has more. Rick, how do you grade it?
Yes, I gave it a B-. It was a pretty solid auction all in all. You could see the chart there. Now, that's a 2-day chart of 7s. Couple things to point out. On the left side, of course, that big up and down was the volatility from GDP. And what usually happens when you get big ranges based on a fundamental release, the markets sometimes average it out and trade right in the middle, which is exactly what the 7-year did, up until the end of that chart where it starts to move lower.
Welcome back to an early edition of Power Lunch today. And why are we early? Because the markets close in 4 minutes, as you can see there. So let's bring you right to that point with Tom Lee. We brought him back, and he has some stocks that are making his nice list this holiday season. They're going to kill me in the back, but Tom, we have to start with something that everybody's lighting us up about since we talked to you 45 minutes ago, which is do tell us about crypto, okay? ETH, they want to know what's your target there. Bitcoin, what do you do with it? It's the one thing that's not part of this melt up that Steve's been observing here.
Yeah. Well, crypto was having a good year in 2025 until October 10th, and suddenly the paths of crypto and gold and risk assets diverged. You know, I think as we look back at that moment, there was a liquidation event that was similar to 2022 when FTX collapsed. So it took 8 weeks for markets and market makers to sort of recover and markets to begin to find their bearing. I think that's what's happening now. The outlook for crypto is still really good for the next 5 to 10 years. I don't want to overuse the word super cycle, but we know that Wall Street wants to tokenize everything, you know, whether that's Vlad at Robinhood or Larry Fink at BlackRock. And that's going to bring a lot of efficiencies to Wall Street, but it really brings the use case forward for something like Ethereum. So we're pretty bullish. I think Ethereum, which is around 3,000, can easily get to 9,000, 7,000 in early 2026. And then over time, as it starts to be competitive with payment rails. Could get to the 20,000 level. So I'm pretty bullish. I like Bitcoin. I think Bitcoin is suffering from gold envy right now.
Yes.
And that liquidation event, gold's been a great asset, now at over 30 trillion. But I think, again, Bitcoin is a genuine store of value. It is supply limited. So I think in next year is really when Bitcoin can sort of begin to recover, and the 200,000 level makes a lot of sense to me.
I want to run through some of your picks, and Steve can take this over. We need to go with it. NVIDIA, top 5 idea, AMD, Meta, Goldman, Arista Networks. Your bottom 5, is that names you guys disfavor, or they're just the second half of the top 5 list?
Yeah, it's our core research core list of stocks we like, but the bottom 5 are the ones that maybe myself or our technician Mark Newton don't think are as timely. So they're
CrowdStrike,
naughty, but not like sells.
Okay, they're not. CrowdStrike, Costco, Palo Alto, Tesla is on that list. What is your message to the Tesla bulls? And Willis Towers Watson, but go ahead.
Yeah, I think Tesla has been on this research list since 2019, so we would never sell Tesla because Elon Musk, there's so much future present value created from a lot of his ideas, whether it's going to be Optimus Prime or robotaxis or XAI. But in the near term, Tesla's had a huge move recently, so I think it is just a question of consolidating those gains.
Tom, when you talk about the top 5, it's diverse industry-wise. Is there any particular industry that you like more than others, as opposed to just the individual stocks?
When I think of 2026, I still like tech for next year, but I do think it is ISM sensitive and interest rate sensitive and dovish Fed sensitive. So it's also financials, industrials, energy, and basic materials.
So the Fed probabilities, when I look at them for next year, I got nothing happening in January, not so much happening in March, maybe April, more likely June. What's your take on the importance of that to the market?
That timeline makes sense because I think until the second half of next year, we're going to have a Powell as the Fed chair.
Yeah.
And from that nomination to confirmation window, you'd have a better sense. That's really when I think the market starts to price in a more dovish Fed. So it makes sense to me that the first half is as a market that's legacy pricing Fed Chair Powell and monetary policy.
And you're sticking with the Mag 7.
Yeah, I still like Mag 7 for next year.
Let's give a quick check as we wrap this up. Friends, this is the closing bell, and the easy headline from today is going to be that the S&P is going out on this holiday shortened session at fresh all-time intraday highs. Steve, we hit that level earlier today. The Dow's up about 280 points. Remarkable, isn't it? There you can see
the market closing on this shortened Christmas Eve trading day at a new record high. It's great to be here.
Yeah.
Hey, everybody. Welcome to Blue Cloud Trading. I'm George. We just saw some clips from the halftime report. We also saw Josh Brown on there. That was from Wednesday's episode. And we also saw Tom Lee. He was also on Power Lunch on Wednesday before Christmas. And so what we're going to do is take a look at some of the stocks they discussed. We're going to look at the technicals, and we're going to analyze those. I'm also going to give you a quick update on what's happening, because today it's Friday, December 26th, as I'm recording this. It's 11:41 a.m. Eastern Time. I am 5 hours ahead in Tenerife, Spain, currently, but I'm putting these out there, folks. And so we're looking at the market live right now. And as you can see, U.S. stocks edge lower in quiet year-end trade as precious metals rally and small caps lag. That's the primary thing to take away here. Dow is down 0.13, not a lot of volume. You can see, so over here, there's a little volume bar. It's called relative volume. You'll notice that the blue right there, it's under the normal. The average is about 1. And so it's below average trading, obviously, right? The holidays. And NASDAQ up just slightly, 0.06 right now. S&P 500 slightly down, 0.01. Russell 2000 is down the most, 0.6%. Let's take a look at the heat map and just get a glimpse of what's happening with the individual stocks in the S&P 500. What we've got here is NVIDIA is up 1.38. Broadcom is up. The semiconductor is doing pretty well, except for Micron's down 0.68. Palantir is down 1.17. Apple's up 0.33. Tesla's down 1.32% currently. Google and Meta down slightly. So if the color of the box is like a darker one, it's like less than 1%. Okay. If it's like bright red, it's more usually like a negative 3% drop. Okay. Or like somewhere between -2 and 3%, like RCL over here. Anyway, let's take a look at the groups. Let's see what specific sectors are performing well today. So far, basic materials and technology are the two leaders for the day. Everything else is down slightly. And for the 1 week, basic materials, technology took the lead there, with financials, industrials doing really well as well. Communication services, healthcare, all these were up like, more than 2%. And then energy was up 1.32. The only one that declined, once again, was consumer defensives. And over here, the 1 month performance, you can see basic materials still up the most, 10.7% for the month, and utilities down the most, 2.83%. All right, let's take a look, folks. And you know what? We are looking, we're basically, the 1 year performance. If you take a look at the 1 year performance, check this out. Basic materials has stolen the show here, right? 38.14%. It was not technology. Technology was only up 20% for the year. Financials, communication services do well. Real estate was the laggard, down 0.85%, under 1%. So you wouldn't have made any money in real estate if you invested there. So let's get into the stocks that they talked about. Now, here's what I'm going to do. We're going to look at the index ETFs, all right, like the SPY, the QQQ, the Dow, DIA ETF. We're going to look at a number, about 20 stocks and ETFs that they talked about on the shows, including Bitcoin. We're going to look at all the list here. What I did prior to recording this video is reviewed these stocks and ETFs, and I gave the strongest ones, a little blue flag because they passed specific technical criteria that I look for before I personally consider adding a position. I'm looking for stocks or ETFs that are strong on both the weekly, okay, and the daily time frame. And that's really important. And I use the Ichimoku indicator. I'll briefly give you guys a quick synopsis of that. We'll also take a look at Tesla, Apple, Meta, Microsoft, and Amazon at the end there. All right. So let me just give you a brief overview, very brief. I'm not going to spend too much time on this here, but we got what we're looking at here is and let me get rid of the lines for a moment so you can see this clearly. And let's make this chart a little bigger too, why don't we? We've got that kind of capacity here to expand the view with TC2000. You can get a $25 coupon for this software, by the way, in the links below. Actually, it's not going to be in the links below. It's probably going to just be on my YouTube channel under the links segment, okay? Click on 9 more links, and that's where you'll find it. So what you're looking at is this very unique indicator called the Ichimoku indicator. It's a Japanese indicator that became published in the late 1960s, okay? And it became popular here in the 80s in the United States. It's based on a multitude of factors, 5 specific lines, all right? You've got your Tenkan-sen, okay? That's also the conversion line. And what it does, it takes the highs, the lows of each candle, the last 9 periods, divides it by 2, and then gives you the midpoint, okay? There it is, and it plots it right under the candle. Then you got the red line that you see there, which is the 26 period. So it does the same thing. Highs, lows of the last 26 periods, divides that by 2, and it's plotted right there. You'll also know something unique about this indicator, these moving averages here, is the fact that they can flatten out. Unlike, for example, the simple moving average, like the 200-day moving average that you see here is a simple one. If you looked at an 8 period, you're not going to see a flattening like that for an extended period of time. But because we are taking the midpoint of each candle, it's giving us a much better average of what's happening. Now, there's one more line here, the Chiku span. That's the closing price or the current price projected 26 periods into the past. We want that white line to be above the candles 26 periods ago. We want price to be above these 2 moving averages. We want the faster moving average above the slower moving average. And then you've got the cloud itself, which is the Ichimoku cloud, and it's comprised of Senku span A, which is this line right here, the light colored blue line, and then Senku span B. And Senku span A is derived by taking the midpoint of these 2 moving averages, projecting it out 26 periods into the future. And then the purple line, the Senko Span B, is the midpoint of the last 52 periods. It's projected into the future as well, not under the candle. So 52 period, the midpoint, okay? And then what we're looking for is a bullish cloud here. We want the Senko Span A, the light colored line there, to be above. We want that light colored line to be above the purple one. We don't want a twist like we had right there where they call that the Kumo twist, where it actually twists under and it gets underneath. That's bearish. We want price always to be above the cloud, not under like it was back here in March. You can see that we had a bearish trend there that was established. Ichimoku stands for at a glance. You want to quickly assess what's happening, and you can look at different time frames. You can look at this on a weekly time frame. All right, you can look at it at a daily. Look at that weekly, very bullish, right? Prices above all those moving averages. We saw the daily. Let's look at the 2-hour right now, since we are midday watching the markets and they're still moving, as you can see right there. Looking pretty bullish here on the 2-hour, right? This last couple of hours, it's been pulling back a little bit. We can look at it on a 5-minute. All these time frames you can look at. Each of these Japanese candlesticks now represents a 5-minute time frame, yeah? So you can see that little pullback that's happening since, here we are, December 26th, right? And you can see, sorry, let me go back here a little bit, zoom out. And yeah, you can see, so the opening price was somewhere around the 930 area right here. It moved up and it's been just dropping a little bit. There's nothing happening here. It's just kind of sideways action. Anyway, what we're going to focus on is the daily charts. And on the weekends, I also look at a much more broader view of sectors. We'll look at some of them here, but it's a much more broader view. So consider becoming a member if you want to get access to some of my member videos. S&P 500, the SPY ETF, as you see here, is down 0.07%. Everything looks good, though. Nothing negative. QQQ ETF, also still bullish. It was up just 0.04%. All right. Everything, all the elements are correct here. The Dow Jones, that's why they have the little blue flag. The Dow Jones is looking good. The DIA ETF looks good, even though it's down 0.16%. All right, just taking a little breather there. FEZ Eurostox is looking good. It's up just 0.06%. It's building what's called a symmetrical triangle right there. You can see that very clearly. Okay, and so if it breaks above the top here, it's gonna probably expand to the upside. If it breaks to the bottom, which I don't expect, but if it does, that's something to watch out for. You get the Russell 2000. Look at the Russell, down 0.71% now. It dropped under the Tenkan. That is not a good sign for the Russell. So the Russell is looking weakest out of the bunch. And so you can see how useful this indicator is because it shows us exactly what's happening in real time. The VIX volatility is up 3.27%. It gapped up slightly here. It's still a very reasonable level of 13.9, which is what we want. We don't want this to be jumping up and hitting levels like 29 like it did back there in October or back in April when we saw the market. That represents volatility in the market. We want the volatility out. All right, let's take a look at the stocks that they talked about and how they're performing today. So XLF is down 0.34%, but still looking very bullish chart-wise. I've already reviewed the weekly chart, so I can tell you that all these look good on both the weekly and the daily time frame. Micron Technology looking good, even though it's down 0.6%. It's creating, I mean, it's kind of taken off here, so I wouldn't be surprised to see it pull back slightly and then maybe find some support at the Tenkan and then bounce off that level and create another leg up. But right now, it's still hanging in there. SMH, the semiconductor ETF, is up 0.58%, looking strong. I like this one. It also broke through this little like the small little consolidation area right there. You can see how it was getting stuck there. It's moving up. I like that. The rest, let's look at XLI. XLI is down 0.37%, but still looking technically sound overall. XOM, Exxon, there's no breakout taking place. Josh Brown mentioned something about a breakout happening in Exxon. That's not true. I'm not sure what time frame he's thinking. This is the daily time frame. You can see the highs here. In order for breakout to occur, price needs to break above prior highs. And it has not broken above any of these highs here. So, in fact, it's dropping. So, and it's stalled right here yet on Wednesday. When the video came out, This is the candle that he made the call on. That was on Wednesday, December 24th. Here we are, Friday, December 26th. We had that 1 day off. So yeah, and let's look at the weekly chart on Exxon. I'm curious to see what that looks like. Yeah, no breakouts happening, but it looks strong, right? It still gets a blue flag because it looks technically sound on both time frames. IBB Biotech is also pulling back right now. It's got a little bit of a slight pullback here. You can see that little decline there. I'd like to see that break through above these levels. Then it might make sense for IBB, the biotech. XLV, down 0.21% currently, but it's holding up above the moving averages. It looks good on the daily, and of course, again, like I said, the weekly chart's also strong here. Estee Lauder was talked about, and that's down 0.15%, and not really nothing happening here. It's just like pulling back a little bit. Technically very sound still. AME is looking good overall, even though it's down 0.19%. It's pulling back a little bit right now. HWM, so what does that mean? If I'm seeing prices pulling back, I'm not buying at that point. I'm waiting for strength to come in. I'm waiting for the bulls to come in and push the price up further. Because, generally, like you can see right here, check this out. I'll show you what I mean. HWM, which is Howmet Aerospace, another stock they talked about, it reached these levels, right? Okay, you can see right there, closed position for a 7 point. That was my position that I closed out of for a 7.9% profit. But see that prior high where it's circled? That's the prior high, October 30th of 2025. So here's what happened with this one. Price came right up to it, pulled back, came back up, did not quite make it, dropped, and now it's retesting. It retested on Wednesday, and here it is on Friday with a negative spinning top. A negative spinning top is a very bearish pattern if it happens at the top of a move. If it happens at the bottom, okay, that can be bullish. So right now, I wouldn't be jumping into this, obviously. And if you guys aren't familiar with candlesticks, very quickly, let me show you where you can get a cheat sheet. My x.com page or Twitter page. If you get on here, look for me at Blue Cloud Trader. Okay. And what you want to do is click under Highlights tab right there and scroll down a little bit. And then there's the candlestick pattern reference sheet, and there's a bearish spinning top. So you can download that if you want. Learn those candlesticks. They're important, I think. So FTX, FedEx, it's down 0.12% currently. On Friday, it's had a really nice long run. It looks good overall. I've got nothing negative to say about FedEx. Now, the rest of these not looking so great. That's why they don't get the blue flag, okay? So we got Toll Brothers. Currently price, as you can see, is crossed on the daily chart under the Tengen-sen for 3 days in a row. So again, something I would probably skip until we see some more strength. India, which was it was a final trade by Stephanie Link. I mean, this is kind of looking like a mess right here, honestly. I don't like this chart at all. You can see there's see those big, like, crazy amount of gaps happening, right? Let me just show you what I'm talking about. You got a gap here, you got a gap here, you got gap here, another gap. Just multiple gaps in this ETF. I don't like this ETF. And just looking at it, you can see what's happening with the cloud itself. It's crisscrossing all over itself. So that's a signal. That's giving us some information. It's telling us that this thing has no clear direction at this particular time. If anything, it's dropping. Okay, so you can see these from Wednesday and Thursday. Wednesday, it re-entered the cloud here when she made the call. So that was not the proper time to be considering this one from a technical perspective. MRP, Millrose Properties, that was Jenny's pick. I don't like this one either. It's under the cloud right now. It's it's above the 200. It's actually a position that I had back on August 5th, and I closed out of it on August 27th. I actually picked the right time to get out. It was on this negative candle after the shooting star. So I made a nice little profit on that. But since then, I mean, it's dropped 14.25%, and it's still declining. It's in a downward trend. So, like, yeah, no on that one. LYV, which is Live Nation. Remember, we talked about that inverse head and shoulders. He talked about it on Tuesday as well. Inverse head and shoulders on Live and Nation Entertainment, breaking through that right there. It's still moving up slightly. It's only at 0.21. There's not a lot of volume though. You know, ideally you want to see the volume start to pick up, and instead it's dropping down here. Okay, so keep an eye on that. But what I do like is the directional movement index itself. This other indicator I like to use is looking very bullish. That's when you see the green line. I've got it at a setting of 9. You can see that green line moving up, and the red line moving down, and the ADX moving up. That's all bullish right there. That's really, the ADX represents momentum. And so that momentum is increasing. We just don't see it in the volume though. So, you know, you got a mixed signal here. What about ZTS, Zotis? No on that one. Stay out of that one for now. It's got a double bottom right here, but not the time to get in. It's under the cloud. And then we got ROK, Rockwell Automation. That's under the Tenkinson. No on that one for the time being. Overall, it's in a nice strong uptrend. It's just like it needs to break through that level, and it might even happen today. You know, right now, like I said, it's almost 12 p.m. You can see the time down here. XLK technology. It's still in this symmetrical triangle. So yeah, I would hold off on XLK. Let's look at the weekly chart for a moment. Yeah, it's still stuck in there. I would actually hold off on that one. But technically, yeah, the one negative thing about this chart, the reason it did not get the blue flag is because the cloud has turned bullish. Senkou span A crossed under the Senkou span B. So that's not a good sign necessarily. And then we've got GRNY. Now they didn't talk about this in the show, but this is Tom Lee's one of Tom Lee's fund strats ETFs. This one looks similar to the XLK. Okay, you can see this, the cloud has turned bearish here, but overall most of the elements of Ichimoku are looking good. On the daily, let's look at the weekly chart on that. See, still looking pretty good on this one too. All right, let's look at the next one, IBIT, which is Bitcoin. And Bitcoin is still in a kind of a slump. As you can see, we've got lower highs and lower lows here, right? And it looks like, yeah, it's still under that trend line right there. So, but it has moved up slightly. I don't know. It almost looks like a symmetrical triangle that's forming once again. It's getting, price is getting squeezed in here, and it could potentially pop, but it has not happened yet. Now we're going to look at some of the Mag 7 stocks. We got Tesla over here, which is down 1.44% today, breaking back under that Tenkinson again, at this time at least, as I'm recording this video. So, you know, not the time to add. As I mentioned yesterday, it was getting stuck at that 488.54 level, which is a monthly level. Purple lines are monthly levels. Here's a monthly chart. And there's the candle. It's a shooting star type candle. That's one of the candles that you'll see on that cheat sheet that I just showed you on my Twitter page. December 31st of 2024. So it has not taken that level out. Apple monthly chart. It's developing a spinning top. Ooh, that's not good on the monthly. On the weekly chart, it's pulled back under the Tenkinson. Okay, and on the daily chart, it is in between the two moving averages. So it's not a buy. Meta is also kind of slumping here inside the cloud. It's under the 200. I'd stay out of Meta for the time being. If it starts to show some more strength, we'll see it on the charts, and then we can act appropriately. But the cloud is still bearish. We still have a series of lower highs, lower lows, and we still have not taken out any highs here. That's what you're looking for. Microsoft is still under the cloud as well. We get a bearish cloud, and the cloud is getting thicker. But it is in between the cloud and the 200 rising moving average. Notice how it's been finding some support here. But I personally wouldn't be adding as long as it's under the cloud. And then Amazon, finally, Amazon. Whoops. There we go. Under the cloud. Nothing to do here either. We do have a higher low from the prior one and another higher low from that prior low. So we've got ourselves a nice little, trend here. The problem is that we've got a lower high here from the prior one. So we did break that though. So this could turn into something, but right now it's still under the cloud. I'd hold off on Amazon for the time being. There are other stocks that they discussed or that you're not seeing here in the Mag 7 that will be covered in the members only video this weekend. If you want to become a member so you can get access to it. And by the way, if you want to lock in the pricing into 2026, what you need to do is become a member, basically before the new year. Okay, let me just show you guys what I'm talking about. This is the channel, Blue Cloud Trading. And the member videos, every weekend I make a video. You can see there's tons of them in there. I've been making these for a while now. And what you want to do next to the subscribe button, it's free to subscribe, by the way. Please subscribe if you haven't yet. Hit the notification bell. And then if you want to get more access to the additional videos, you click on the join button right next to it. This will pop up. You'll see membership at the top here. And it says join this channel. Get access to the membership perks. Okay, there's 3 levels. There's Blue Cloud Supporter. Under this level, you'd be supporting the channel, and I'd really do appreciate the Blue Cloud supporters out there that are helping keep this channel alive. We got Blue Cloud Trader level. Membership is the next level up. That's where you get access to those exclusive member-only videos, all right? And then the next level up from there is Blue Cloud Legend, okay? These prices, like I said, will... So the Blue Cloud Trader and Blue Cloud Legend will go up in January at some point. So if you want to lock in, now is the time to do it before the new year. I'm going to leave the Blue Cloud Supporter at the same level. All right, and I do appreciate you guys for supporting my channel. And so what do you get under the Blue Cloud Legend level membership? There's a few other perks that you get. There's some recorded day trading videos that I've made. If you want to see those on shorter time frames, I've also made some daily trade. I do daily trade updates on the entire portfolio. So in that members only video that I do on the weekends, I go over my entire portfolio, all the stocks, all the ETFs that I'm holding, which ones did I close out throughout the week, which new stocks did I add. I also provide 25 new stock ideas. So there's a lot that you're getting. And I also share my with Blue Cloud Legend level members, you get a daily scan of all the stocks that pop up on my proprietary scanner that looks at the strongest stocks on the weekly and daily charts. Okay, that's giving a buy signal on the daily, but they look bullish on both time frames. And so I call that the Blue Cloud scanner. And so if you want to get access to that, become a Blue Cloud Legend level member. And if you want access to more of the links right here, click on 9 more links right there. Read a little bit about my channel, scroll down, you'll see there's a whole bunch. And there's that $25 coupon for the TC2000 software that I use, the trading software. Click on that there. There's my Twitter page link. Okay, all the links are right there. Some property management software, NordVPN, 3 free months. You see it all. All right, guys, thank you for watching. I'll catch you all in the next one. Remember, this weekend I'm putting out that next members only video. Thanks.